Good afternoon, ladies and gentlemen. Welcome back to the first weekly market review for the month of December. So fast, 1 year have flown past already. And today I have with me Mr. Gerald Wong. How are you, Gerald?
Yes, we are now in the month of December. I see more people going on holidays, just taking some break from their usual routine. We are also going to be rounding up our weekly market review and sharing more about what has happened in the past year, as well as what to look out for in the year ahead in the upcoming weekly market reviews.
Yes, indeed. Talking about coming to the end of the year, I think the year is ending quite well. Last week we saw all the US indices ending in the green. We are up like more than 1% on the S&P and the Nasdaq Composite Index. And Singapore side is not doing too bad as well. Although we had a slightly negative week last week on the STI, but this morning I see STI index up about 0.6%, and we could be having a new year to date high or a multi-year high again on the STI. So, Gerald, will you be sharing some of the news and happenings with us today?
Sure. Okay, the usual disclaimer that today's sharing is for information purposes only and should not be taken to be financial advice. We have the final Ask SIAS on the 11th of December. So if you'd like to register for this Ask SIAS, you can scan this QR code and registration will close on the 10th of December. Okay, if you find the weekly market review helpful, do leave us a review on Google. And if you're wondering how you can join SIAS as a member, you can go to the URL sias.org.sg/membership or scan this QR code. And as a SIAS member, you'll be able to access various online resources as well as investor education programs. Okay, like Sunny mentioned earlier, we saw a strong performance by US stocks in the past week, where the key indices closed at record highs. The S&P 500 6032 with a 1.1% gain, and we see that the gains are broad-based with both the tech stocks as represented by the Nasdaq, as well as the other stocks also doing well with the Dow Jones up by 1.4%. Singapore was down slightly by 0.2% to 3,739 points, but this is still at a fairly elevated level. Okay, the key news for the past week, it was a light week because of the US holiday, but in the week, we saw the nomination by US President-elect Donald Trump of his choice of a Treasury Secretary, ex hedge fund manager, and I think investors viewed that as something that was a positive because of his more measured approach towards policies. So with that, we saw a decline in the US government bond yields from at one point close to 4.5% to now at about 4.25%. Okay, and likewise, the Singapore bond yields fell as well. If you are someone who's interested in T-bills and Singapore savings bonds, just be aware that the 10-year Singapore government bond yield fell to 2.78% last week. At one point, it was actually back to close to 3%, but with the fall in the US government bond yields, we saw a decline in Singapore as well. Okay, so with the fall in the bond yields, naturally we expect that some of the REITs have started to rebound. In terms of the STI top gainers in the past week, we see Mapletree Logistics Trust, CapitaLand Ascendas REIT, Mapletree Industrial Trust, all having gains of more than 2%. And I think that is a reflection of the fall in the bond yields over the past week. Okay, in terms of the worst performance, we see some profit taking in some of the engineering names that have done well so far this year, including Yangtze Shipbuilding down by 10%, ST Engineering down by 4%, and SETS down by 2%. Okay, so I mentioned earlier that some of the REITs have rebounded slightly, and we see that amongst the industrial REITs in particular, with Mapletree Logistics Trust, IMS APAC REIT, having gains. So that is really a reflection of the decline in bond yields. Okay, the other big news that came out in the past week relating to the REITs, was the MAS new ruling that REITs would be subject to the following: a single leverage limit of 50%, and then all REITs must meet a minimum interest coverage of 1.5 times at all times. Okay, so compared to what it is currently, REITs actually have a leverage limit of 50% as well. But if their interest coverage ratio exceeds 2.5 times, then this leverage limit comes down to 45%. So that has now been standardized, and all REITs would then be subject to this interest coverage minimum as well as leverage limit. Okay. At the same time, in terms of the disclosures, REITs are required to perform and disclose sensitivity analysis on the impact of how their operating profit or EBITDA and interest rates will impact their interest coverage ratio. Okay, so what we do see is, number one, it has been standardized across the board, and REITs need to provide this disclosure to provide more transparency to unit holders, which will hopefully help you make a more informed decision about the financial strength of the REIT. Okay, if you're wondering what is the interest coverage ratio, effectively what this does is that it measures the REIT's ability to be servicing its debt. Okay, in terms of how it's measured, we take the operating income divided by the interest expense, as well as for the REITs that have got perpetual securities, the dividends that then need to be paid. Okay, so what it effectively does is that for a REIT with low operating income in relation to its interest expense, would then have a low interest coverage ratio. And what this means is that this will be seen as a sign that it has a lower ability to be servicing its debt. Okay, so what we would prefer would be a REIT with typically a higher interest coverage ratio, because it means that it's able to generate more operating income in relation to the amount of interest expense that it has to pay. Okay, so in terms of how it will impact the REIT sector, it will give the REITs more flexibility to be able to manage their capital, particularly for the REITs that have a interest coverage ratio of between 1.5 times to 2.5 times. Previously, they would have been limited because their maximum gearing comes down to 45% once their interest coverage ratio actually exceeds 2.5 times. Okay, but with this, effectively, they have more ability to manage their capital and think about different ways that they can then still potentially grow the REIT through different initiatives that can be undertaken. So some of the REITs that have a interest coverage ratio of below 2.5 times are provided a list here. So some of the familiar names would be names like Landlease REIT, Sunset REIT, that have a interest coverage ratio of below 2.5 times. Okay, so in terms of where REITs are today, we see that they have actually corrected from the recent highs. This is because the bond yields have actually gone up after the US Fed cut interest rates surprisingly. And that is a reflection of the expectations that interest rates may then not be cut as aggressively going to 2025. Okay, so over the past week, we saw a bit of a rebound. That is a reflection of then the fall in bond yields over the past week. So going ahead, we need to look at what are the expectations of interest rates going to 2025. Okay, so based on the latest expectations, the Fed is expected to cut interest rates by 2 more times in 2025. So we have an upcoming Federal Reserve meeting in December. There's now a 66% likelihood of a rate cut in December, which will bring the benchmark rate down to 4.25 to 4.5%. Then going to 2025, based on current expectations, interest rates are expected to be cut by another 2 times by the end of next year. Okay, so if there are going to be more rate cuts than expected, we might see a further decline in the bond yields, given that expectations have now moderated very significantly. Okay, the next name I wanted to talk about is CapitaLand Investment that had its strategy day recently. For CapitaLand Investment, we saw this rebound in the share price following the announcement of the China stimulus. They brought its share price up to above $3.10. But with the moderation in expectations of the China stimulus once again, it has come down to $2.73. Okay, so in terms of the key takeaways from its strategy day, what the company has set as its target would be to grow its fund under management to 200 billion by 2028, from 99 billion in 2023. So this will be through a combination of a few things, including growing the funds under management under its listed REITs. Okay, we see that already being part of its initiatives in terms of growing the asset under management of the REITs. Then likewise on the private funds, there's also an objective to be able to grow the funds under management with its private funds. And last but not least, with some acquisitions, they hope to then bring the funds under management to 200 billion. Okay, so with the growth in the fund under management, they are also expecting that the fee-related earnings to be able to grow from 318 million in 2023 to more than 650 million by 2028 to 2030. Okay, so while the funds under management is growing, what is also important to note is that there is going to be an expected shift in terms of where they are going to be exposed to across the different geographies. So the key one to highlight is that for China, currently it's at 27%, but that is expected to come down to 10 to 20% of its 200 billion fund under management by 2028. On the other hand, we see some of the other markets such as Australia, South Korea, and Japan expected to increase to 25 to 35% from 18% currently. Okay, so within this growth in this fund under management, some shift expected in terms of the geographical mix. Okay, in terms of the valuation of CapitaLand investment now, given that the share price has corrected from October, the price to book is just slightly above 1 times and is below the historical average. And the dividend yield is at 4.4%, which is slightly above the historical average. In terms of what to look out for in the week ahead, we are going to December, so it is quieter with no major corporate earnings expected. But we have the last Singapore savings bond application that will be open today on the 2nd of December. We have an upcoming 6-month T-bill auction as well on the 5th of December. And if you want to learn more about REITs, particularly REITs that are exposed to China, there'll be a SIAS Corporate Connect tomorrow on the 3rd of December. In terms of major economic releases, we have the US non-farm payroll data that'll be out this Friday, the 6th of December. Okay, so those will be the key things that I'll be keeping a close lookout for. And with that, I'll hand over to Sunny, who will share the technical analysis.
Okay, thanks Gerald for going through some of the updates on the Singapore markets and the REITs. So yes, tomorrow I will be hosting the Sessual REIT Corporate Connect session. So do sign up and tune in. And on the economic calendar wise, yes, this week we are starting with the non-farm payroll data as the first week of every month. And of course, the second week we are always looking at the CPI data. And then in the third week of December, we will be looking closely at the rate decision on 18 December. So these are some of the key macroeconomic data that will be coming out in December. In case you're on holiday, I'm giving you a heads up first. So let me start with the roundup of the US indices first. So the US indices actually ended the week on a positive note. The Dow Jones and the S&P 500 and the Nasdaq Composite Index all up more than 1%. So the Dow Jones Index, as you can see over here, is performing very strongly. Okay, it has not even retraced below the 20 days moving average, and thereby I do not have a chance to sort of get in back into the US indices yet. So looking at the indicators of the Dow Jones index, we can still see a very strong positive reading on the MACD indicator. We also see a very strong movement in the RSI, even though we are approaching the 70-point mark, which traditionally is the overbought level. So I just want to reference the previous period in July where the RSI hit a high of 83 points. So between now 70 points, 69 points to the 80 points, there's still a 10-point level before I think the Dow Jones index will sort of exhibit some form of a overbought signal, which means a technical retracement could be inside. So I would like to adjust the entry into the Dow Jones index slightly higher. So instead of looking at the 50 days moving average now, which is likely unable to get, so we might likely have to move it up to the 20 days moving average over here, somewhere around the Bollinger Band basis at 43,700, 43,800 level. That would be a level that we are at least I'm looking at to getting back into the Dow Jones index. So this is also supported by some of the big US banks, which had very strong performance. And going forward, with what Gerald said earlier, that we might not see so much rate cuts next year, it is also good in terms of the interest earnings of the banks going forward. So I'm looking at the Dow Jones index to get back in on the 20 days moving average around the 43,800 or 43,700 level, with the next support level, of course, back to the 50 days exponential moving average around the 43,000 handle. Okay, so that's my take on the Dow Jones index. Next, let's move to the broader index, the S&P 500. So the S&P 500, as you can see, mimics the performance of the Dow Jones as well. We got a all-time high and all-time closing high both for the Dow Jones and the S&P 500 last week. So we are into uncharted territory. Up here above this level of 6,000 points, we have not really come to this zone before. So we do not have any indication of what kind of a selling pressure or who are the sellers that may be at the top over here above the 6,000 mark. And my guidance resistance would likely come in would be using the Bollinger Band, because statistically 90% of the time the calculations always shows that the trading range usually falls within the two standard deviations, with is the upper bound and the lower bound of the Bollinger Band, where you can see over here in August it dropped out of that and then strongly rebound. So resistance level, we are looking at the 6,100 level for the S&P 500 index, and we are about 70 points away from that. We still have a positive reading on the MACD indicator, although not a very strong positive reading, but it indicates the presence of uptrend momentum. On the RSI, the reading at 65 points is also very healthy, supported by their 14 days moving average at 61 points. So we are about 5 points away from the 70-point overbought level. And referencing the July period, the high went up to as high as the 81-point level. So I think with all the positive news that was coming out in recently, especially last week, where the semiconductor equipment sales to China may not be as bad as previously thought, that gave a jump to some of the semicon names like Lam Research and Nvidia, up 2 to 3% respectively. So this could propel the index higher as well. But for the S&P 500, because it's a broader base index, there is likely going to be more volatility. I'm not going to adjust my entry level on the S&P 500 index to the 20 days moving average yet. I'm still holding on to wait for some of the important macroeconomic data coming out, especially the non-farm payroll data that will be coming out this Friday, because in the previous month, we had the sort of a outlier reading of the 12,000 kind of a non-farm payroll data that came out, which isn't significant, and usually it comes out in the range of 100 200,000. So that will give me a updated and informed view of how the US economy is doing. So in case you are looking for a first sign of some kind of a pullback or recession in the economy, then this is the important data that you should be looking out for. So S&P 500, even though this is what I've said that we could get in the previous week, the 50 days moving average, which is the blue line that you see here, has moved slightly up. So we need to adjust this upward over here. It is now at the level of 5,836 points, with the 20 days moving average at 5,929 points. So next year going forward, I think the 6,000 level would likely be a pivot point for the S&P 500 index. If let's say economy is going to perform very well, very strong, job numbers are going to be improving, then definitely a lot of investors will be looking at holding above the 6,000 point level as a psychological level. Okay, lastly, let's move to the Nasdaq Composite Index, which had a very good performance last Friday, up 0.83%, closing at 19,218 points. You can see that the Nasdaq Composite is holding very tightly to the 20 days moving average. So there's not a lot of a lot of enthusiasm or optimism buying into the Nasdaq Composite Index, or there isn't also not much of a negative sentiment into the Nasdaq Composite Index as well. So we are trending very closely to the 20 days moving average. Thereby, it does not give me any opportunity, because if let's say it's going to fall below the 20 days moving average towards the 50 days, there is the chance that I'm looking at to get in. But then market is very well priced in right now, all the news and all the risks that we are facing right now. So there isn't much of an opportunity at this point for me at least. Okay. So according to the MACD indicator, we have a very slight negative reading. That means that there's not much of a uptrend momentum in the Nasdaq Composite Index, and there could be a little bit of a downtrend momentum because of the recent observation that we see. Investors might be rotating out of the tech stocks towards the more industrial or economic sensitive sector like the financial sector, and that could explain the recent outperformance of the Dow Jones Index and the S&P 500 above the tech names. Okay, so the RSI reading at 61 is also healthy. So you can see that there's a contradiction of the MACD and the RSI indicator on the Nasdaq Composite Index. Although the RSI show a very positive reading of 61 points, which means it still have a 10 points, at least a 10 points upward move before it hits the 70 point overbought mark, and it's also 10 points above the 50 point neutral mark, indicating uptrend momentum is healthy. Okay, so with this contradiction of the indicators, it tells investors or traders that there isn't really much actions that you need to take right now, unless overbought or oversold conditions sort of present itself again. Then you would have a better trading setup to gain the sort of unusual movements or the sort of volatility in the indices. Okay, so but then statistically as a whole for the December period, we usually see a sort of a positive kind of movement. If I'm going to scroll out right here, you can see the last quarter of last year on the Nasdaq Composite Index, we also saw a rally, and especially in the December period as well, the rally is pretty strong. So I believe for this year there is still likely going to be a rally in December, a center cost rally, but then it may not be as strong as last year, but I'm still positive as a whole, and that could give us a better footing of setting up our portfolio in January of next year. Okay, next let's move to the STI index. So STI index actually closed down 0.2% last week, which isn't much of a significance, because on this Monday morning, 2nd December, we can see that now the STI is up almost 0.5%, 18 points up. And the high on this today, at least for now, is at the, 3,771 points. So this is a multi-year high, a year-to-date high again. But whether we can close above the previous closing high, that remains to be seen within the next 6 hours of tradings on the STI index. But then according to the indicators wise, we are seeing some kind of a negative reading on the MACD indicator. But in the last few trading sessions, it's also saying that the negative momentum is sort of subsiding. Hence, I think STI is likely going to stay in a range bound kind of formation. Yes, we have a slightly breakout this morning, but I don't think we will likely going to test the upper bound of the Bollinger Band now at the 3,800 points level. So just an update, the all-time high of the STI index is in October 2007, and then during that time we saw the STI at 3,906 points. So are we going to challenge that this year, this month in December? I don't think so. But then we are looking, it is still looking positive for the STI next year because based on the price to book of the STI, right, it's now about 1.7 times, and that compared to the 2.5 time price to book in October 2007, it could tell us that STI may have some room to run next year as well. Okay, so we are looking forward to that. This first support level will be the 20 days moving average at 3,700 points around over there. And then the next support level on the blue line, which is the 50 days moving average at 3,643 points, starting to converge with the lower bound of the Bollinger Band, 3,625 points, thereby giving more kind of a support on the STI index. So where is it likely going to trend? The range bound movement of the STIs is likely going to range around the 3,750 points level, with the support coming in at the previous high on 24th September at the level of 3,650 points. So 3,750, 3,650, that is the range that we are looking at for the STI index for this month. Okay, that's my opinion. Okay, so these are the updates that I have for you this week. And then anything else to add, Gerald?
Yeah, so I think all the markets are looking fairly positive at this point in time, with fairly strong investor mood going into the year end. We still have a few economic data points that are coming out, so we look out for those and see how they will continue to drive the market over the next few weeks.
Yes, and we will continue to update our viewers here on the weekly market review. So I think that's all the time that we have. So everyone have a good trading week ahead, and we'll see you same time, same place on the next weekly market review. Goodbye.
See you.